From the domestic perspective, yes, it's good that we dip in the market, particularly to have benchmark for the private sector. But at the same time, the government needs to have a balance. Also, don't forget the fact that if Naira is actually stable, for example, in 2012, Naira did appreciate about 3%. And year to date now, yes, we've seen some volatility in between across the months. But of course, on a year-to-date basis now, Naira is still within the tobacco market, just about 3% depreciation in the Naira year-to-date, meaning that Naira is still relatively stable, at least when you compare it, for example, to the South African Rand, which has lost about 15%. When you compare it, for example, to the Ghanaian cedi, which has been under pressure on a year-to-date basis, and that's been almost about 2 years pressure now. So for me, I think in as much as we see the stable exchange rate environment, it's cheaper for the government to also borrow outside the country, beyond the fact that there's also the need to moderate what we borrow from the local market to avoid crowding out the private sector, which of course is also very important because the government cannot continue to lead the economy. It's important that we also allow the private sector to take a major role in development of the Nigerian economy.
But we've also had international companies, like the IFC, for instance, coming in to issue local currency bonds to, among other things, according to it, support the development of the domestic capital market, which is what you've just mentioned already. Now, how successful would you say this has been? Has it, made any impact as much as one would expect?
I think the major impact for me, it's not so much of raising that fund by IFC. I think it's more of what they're going to do with the funds. Typically, if you track IFC's investment strategies, is largely to deepen some specific sectors of the economy and also to create what I call access to finance for the SMEs.
But then I thought it was supposed to work closely with the private sector.
Yeah, that's why I said it's more important to look at the benefits, not only from the perspective of deepening the capital market and the bonds market in particular, but of course the benefit of what they're using the funds for. I'll give you a simple instance. Part of those funds is actually to enable some access to finance by the SME guys. For example, they've invested in quite a number of companies, small and medium-scale enterprises. They've invested, for example, in some microfinance and microcredit organizations where typically they provide more funds for this SME fund, SME finance-focused enterprises. Like, for example, if you look at the typical microfinance, they give credit as low as 100,000 naira, less than $1,000, for example, to small enterprises, traders, market women who are just coming up. And of course, these are people that cannot typically go to the bank to get credit. Those people can actually not, their companies are not credible enough to come to the bond market on their own to raise funds. So which is why the benefits is beyond deepening the local market, but more of what they do with the funds. Because of course, we're talking about creating access to finance for the SME guys. We're talking of deepening some particular sectors of the economy. I'll give you a simple instance. When flour mill came to the market in 2010 to actually raise about 35 billion bond, it was a very successful offer. I'm not so much impressed by the fact that it's successful. I'm more impressed with the fact that the use of the proceed, it's something that would actually benefit the Nigerian economy. For example, the major use of that proceed was to build a sugar refinery, which of course, you're creating jobs. You're also building local supply of sugar. So for example, if a Dangote, for example, comes to the market to raise debt through banks, it might have done that, for example, through bond issuances, which of course is in the process of establishing a refinery, about 400,000 metric tons refinery, which is almost up to the ton of what we currently have now as a country and all the 4 refineries. So if such investment is done, so I don't see it only from the perspective of deepening the local market. I see from the perspective of the benefit that the use of the proceeds creates for the entire economy, either in terms of job creation, in terms of filling the supply gap that we have in the country today, which I think is one of the major problems that we have as a major importing country.
What the states are doing as regards raising bonds, because we see that some states have actually taken, that step to do that, but not a lot of them are doing it. And from everything you've just said, that's like one of the surest ways of raising monies to, fund infrastructure and development at the state level. So are they all aware of the potentials that the bond market actually offers?
I think they are aware. As a matter of fact, you just mentioned that a couple of states actually issued bonds in the past, and some are still planning to issue even before the end of the year. But I think the important thing is the fact that the other states need to work very closely with financial advisors like us, for example. The Lagos State, for example, has been renowned for raising bonds in the local market, and their bonds offering has always been very successful. We've seen issuances from other states. Delta State, for example, issued bond last year. We saw Lagos State, another tranche
Even Kwara too.
this year. Kwara State has done in the past, Edo State. So virtually across all the geopolitical zones, we've seen subnationals coming into the market, and you just even mentioned a new dimension to the subnational bonds in the market, which of course is the state bonds in the market now. The issue of the Sukuk that was actually issued last month
By Osun State.
By Osun State. I think the important thing that we have to look at here is the fact that there's need to work closely with the financial advisors who typically would prepare the state for bond issuances for those that haven't issued any bonds. And for those that also want to issue more bonds, it's also very important to prepare them, either in terms of what they need to do so that they can have full compliance to what the SEC requirements are. Beyond that, there's also what we call the need for us to look into their accounts and to also look into the overall finance of the state to see what is optimal for them. It's not just enough for a state government to come into the market to raise bond. It's also important to look at the other avenues where they can actually raise funds. For example, there are different avenues. Is it through the IGR? For example, we've seen significant improvement in the Lagos State internal generated revenue over the last 8 to 10 years now, over the last decade, and that's largely because of the fact that they've been able to block so many of the loopholes in the tax system. And not only that, they've also been committed to the development of some particular sectors of the economy that at the end of the day then has ripple effect in terms of the tax base. So it's important for the state to work closely with the financial advisors who can actually do that for them. And of course, we would also advise on the right steps to take with respect to what is the optimal decision to take before you then decide on whether you need to issue a bonds or not.
Abiola, I'm just looking at this market as an elitist one. Is it an elitist one? Is it for a certain class of people only?
No.
So people don't really understand what this market is all about, because we see that there's been more growth in the corporate market than in the retail one. Why?
I think two reasons. One is the education, which I think we as financial advisors, we have the responsibility to continue to engage people either through investor clinic or through forums like this, where we can actually educate people that even the local retail investors can actually buy bonds. That's one. The other perspective has to do with the fact that the liquidity of the market, it's a little different from what you find from the equities market. Most retail investors seem to understand the equities market better than the bonds market. And that's because even with as little as 100,000 naira, even 5,000 naira, you can actually buy equities.
But you can't do the same.
But for the bonds market, trading in the secondary market is a little different. Different in the sense that it's largely the PDMMs that trade in the secondary market for bonds, as against the equities market, where, for example, you can place order to my own subsidiary, UBA Stockbrokers, for example, and buy securities even as low as 10 units of, say, for example, UBA stock or maybe a First Bank stock.
Right.
In the bonds market, it's not as easy to do that for the typical retail investors because of the minimum requirement of 100 million, for example, which most retail investors cannot afford. But the interesting thing is the fact that the retail investors can actually buy or sell bonds through the Nigerian Stock Exchange, which of course is also another platform, is the normal platform where they trade their equities. Now they can also do that for bonds. And I think another interesting thing is the fact that retail investors can also take advantage of mutual funds. For example, one of our own subsidiaries, UBA Asset Management, has a mutual fund, a bond fund. So retail investors can buy into the bond fund, and the bond fund again would invest in bonds. So indirectly, you have a direct exposure to bonds, and you get the same coupon that the fund gets. So you get the benefit of investing even with as low as 10,000, 50,000 naira. So that limitation, I think, has been solved by the mutual funds. And of course, now that even the Nigerian Stock Exchange has put in place that platform for retail investors to also participate, I think it's very important that we continue to educate people on how to actually trade bonds and also to get the benefit of this relatively risk-free, high-yield instrument that we have in the market now.
This is a very wide topic and we can go on, but we don't really have so much time. I just got a message from one of our viewers, Igudaro Alonge. He's asking that how come we have a low issuance of bonds by corporates, and why don't they see it as a cheaper means of funds compared to the banks? Okay.
I think there are two reasons for that. One is what I mentioned earlier with respect to the government borrowing, overcrowding the private sector borrowing. For example, in 2010, we had significant issuances of corporate bond. Even for medium-scale enterprises like Tower, for example, he issued bonds in 2 tranches. Dana, for example, he issued bond in 2011. And of course, we got the likes of UBA PLC, we got the likes of Flyme, which I mentioned earlier, issuing bonds in 2010. For example, Flyme did their offer in 2010 at 12%, because the comparable FGM bonds at that time was actually trading around 10.5, 10.6%. So typically, the high yield environment that we have now has discouraged the corporates from issuing bonds. I'll give you a simple instance. If a corporate is coming to the market now to issue bonds, it will be priced at premium to the comparable FGN securities.
And what's the premium we're talking about? Say,
for example, the DMO offering that would come up. Let's take the September, which is one a reality now.
Yeah.
The September bond offering, the reopening of the 3-year instrument went as at 13.5% at the September bond issue. Meaning that if a typical corporate wants to borrow, it cannot borrow less than that 13.5% that the FGN actually borrowed in September for the 3-year instrument. Of course, by the time you put a premium, let's assume we put a premium of 200 basis points, depending on the credibility of the company, in which, of course, would inform the rating that particular issue would have. Beyond that, it also depends on the time, which is why I said timing is very important.
Yes.
The time was right in 2010. But because we've had a very high yield environment, 13.5% for the 3-year FGM bond, meaning that if a corporate is coming to the market, the corporate will be offering perhaps 14.5, 14.75, which is typically a little higher. And of course, it's a little difficult for some small enterprises to actually meet this requirement. For the top grade companies, the difference between the bond offering, bond opportunity, and of course, loans that they get from the banks is not significantly different from what we have now, which is why a good number of them are shy of issuing bonds right now. But I think once we have a lower yield environment, we'll continue to see more and more corporates. But as a matter of fact, I think even for some corporate, it's still very much efficient for corporate to also come into the market, even at this time, to also raise bonds, particularly those that have interest that is far higher than what they can get in the capital markets. Well,
thank you so much, Abiola, for sharing your thoughts with us today on the program. This conversation is a very long one, and it doesn't end here. I'm very sure we'll see you again very soon.
It's my pleasure. Thank you.
Well, I've been speaking to the head of research of UBA Capital, Abiola Razak, and we've been looking at the Nigerian bond market. As I said, it's a conversation that continues even after here. I'd like to also thank Igodaro Alonge for sending in his tweet. But that's the program for today. Thank you so much for being a part of it. I'm Harriet Agbenyi.